Everyone in options trading will tell you the same thing. Volatility is unpredictable. You can't time it. You can't forecast it. Just accept it and move on. We didn't accept it. We went through years of data on different asset classes and asked a simple question. Is volatility actually random? Or is the market quietly sending us a signal that is easy to ignore? What we found was consistent enough to make us rethink how we look at options pricing entirely. And today, we're showing you all of it. And once you will know the theory, we will explain to you how to use implied volatility to optimize your trades with Option Samurai.
Implied volatility, or IV, is one of the most talked about concepts in options trading. Traders rely on it every single day to price options. And yet, the common belief is that volatility is impossible to predict. So we asked a simple question: is that actually true? Turns out, it depends on when you're looking. At the extremes, volatility behaves in a very consistent way. Think of it like gravity. The long-term average of IV acts as a gravitational pull. IV moves around it, overshoots, and then gets pulled back. We backtested exactly that. Here's what we found. Let's start with how to measure whether implied volatility is high or low at any given moment. This is a concept often referred to as implied volatility percentile. On our platform, we call it rank to measure exactly that. For example, if a stock has an IV rank of 95, it means 95% of days over the past year had lower IV than today. In other words, IV is high. And if the rank is 8, the opposite. IV is historically cheap. So we asked, after IV rank hits an extreme, what happens to IV next? We ran backtests across 5 years, major index ETF, commodity ETF, and individual stocks. The answer is consistent across almost every asset we tested. When IV rank is high, above 50, above 75, above 90, IV tends to decrease over the following days and weeks. When IV rank is low, below 50, below 25, below 10, IV tends to rise. Before we dig more into the numbers, let us quickly show you how to read this table. Each row is a starting condition. It tells you how extreme IV rank was when we looked. Each column is a time horizon. What happened to IV after 5, 10, 20, or 30 trading days? And the value in each cell is the average percentage change in IV from that starting point. So for example, when SPY's IV rank was above 90, implied volatility dropped an average of 28% over the following 30 trading days. Red means IV fell. Green means it rose. Now you know how to read every table in this video. Going back to our analysis, we noticed that the IV mean reversion effect gets stronger the longer you wait. One important nuance: in the very short term, 5 days or less, IV can show momentum. It may keep moving in the same direction or stall before it reverses. So this is a longer-term mean reversion edge, not a day trading signal. Now keep this pattern in mind as you will see it again later in the video. Why does this matter? Because buyers and sellers want completely opposite things from IV. Options buyers are favored by rising IV. They want to buy when IV is cheap, low rank, so that implied volatility expands in their favor. Option sellers want the opposite. They look for high IV, rich premium, so they can sell expensive options and collect the credit as implied volatility falls. Same indicator, 2 completely different strategies. And now you know which side of the trade to be on. And later in this video, we'll show you how to find these setups in seconds, directly inside Option Samurai. Now let's talk about realized volatility, RV for short. While IV is forward-looking, RV measures what volatility really was, the observed movement over the past month for the underlying asset. We ran the same backtest, RV percentile rank versus future RV change. Same assets, same time period. The result? Same direction as IV. When RV rank is low, real volatility tends to increase over the following weeks. When RV rank is high, it tends to come back down. But here's where RV is different from IV. In the very short term, the first 5 days after extremely high RV, you don't always see a reversal. The momentum effect is even more visible than with IV. At 30 to 45 trading days though, the mean reversion is clear and strong. You can see this pattern across every asset class we tested: indexes, commodities, individual stocks. The direction is consistent. So the key takeaway is that RV is mean reverting too, but it's slower. The signal is real, you just need to give it time. This is what we do. We take real data, run the backtests, and show you exactly how to turn it into trades. Right now, we're working on a deep dive into the long-term zebra strategy, and trust me, you don't want to miss that one.
Hit like and subscribe so it shows up in your feed when it's ready. So far, we've tested IV and RV in isolation. Now let's cross the two signals. First question, can IV rank predict future real volatility? Yes. When IV rank is high, above the 90th percentile, real volatility tends to increase in the short term. In SPY, just to name a ticker, that's an 11% increase in the first week and nearly 16% in the first 2 weeks. But then it reverses. In the following month and beyond, real volatility comes back down hard. This makes sense. When implied volatility explodes, it's usually because something is about to happen. Earnings, big news, a macro event, you name it. What matters is that real moves follow the fear. Then the dust settles. And that's exactly what the data shows. In the short term, real volatility follows the spike. Then, as the event passes and fear fades, everything reverts. Now the opposite case. Can RV rank predict future implied volatility? Yes, but the evidence is clear. The effect is softer. That's because RV is a lagging indicator. It reflects what already happened, so its pull on implied volatility is clear but less sharp. In SPY, after RV rank hits the 90th percentile, implied volatility fell 3.6% in a week, 7.4% in 2 weeks, and nearly 19% over the following month. And after low RV rank, implied volatility tends to rise. Same direction as everything we've seen, just gentler. So what's the practical takeaway from all three pieces of research? You have two independent tools, IV rank and RV rank, both pointing in the same direction. Use them together to find your best setups. And how do you turn this into trades? You already know the tool, IV rank. It tells you at a glance whether implied volatility is high or low relative to the past year. High IV rank means volatility is expensive. That's when you want to be a seller, selling premium, collecting high credit. Low IV rank means volatility is cheap. That's when you want to be a buyer. For instance, you may want to go with long calls, puts, long straddles, strangles, or similar positions. This isn't theory. It's built directly from the backtest you have just seen. And in Option Samurai, you can build these scans in just a few clicks. Let us show you. Let's open Option Samurai and build a scan from scratch. Hit Compose New Scan. This is where you set your filters. Select Naked Put from the strategy dropdown. You'll see a set of predefined filters load automatically. These are sensible defaults for liquidity, expiration, and so on. Leave them as they are for now. The one filter we care about right now is IV rank. Find it in the list and set it above 80 because you want IV to be high when selling options. That's our signal. We only want trades where implied volatility is expensive relative to its own history. That's the edge the backtest showed us. Hit Run Scan. The results populate instantly. Every row is a trade that meets our criteria right now. Click any trade and go to the Options tab. You'll see this chart. Blue is implied volatility. Orange is realized volatility. This is exactly what we've been talking about. You can see at a glance whether IV is elevated, where it's been, and whether the gap between IV and RV is wide. That gap is your edge. Now let's go one level deeper. Click Add Filters. Search for RV percentile and add it. Remember from the backtests, when RV rank is also high, the signal points in the same direction. You're stacking evidence. You can also add IV minus RV percentile. This measures the spread between implied and realized volatility. When IV is significantly higher than RV, options are pricing in more fear than the asset has actually been showing. That's another cool setup for a seller. You can enter a value for the new filters you added, like IV minus RV percentile above 60, and then run the scan again. Your results will update to reflect the tighter criteria. You now have fewer trades, but each one has more evidence behind it. Give the scan a name, something like Selling High IV Puts, so you can come back to it. And don't forget to save it. That scan is now yours. Run it anytime you want to find high IV rank selling setups across the market. One quick note. IV rank is powerful, but it works best when you combine it with other indicators. Don't use it in isolation. And now the other side. When IV rank is low, you want to be a buyer. Here's how you find those setups. Go back to the scan list and hit Compose New Scan another time. However, now you will select Long Call from the strategy dropdown. Same as before, you'll see a set of predefined filters. Leave them as they are. The one we're changing is IV rank. Find the IV rank filter and set it below 20. As buyers, we want implied volatility to be cheap, compressed relative to its own history. That's the setup where a buyer has the edge. Run the scan. Every result here is a stock where options are historically cheap right now. Click any trade and go to the Options tab. Look at the chart. Blue is IV, orange is RV. When IV is low, and especially when it's sitting below realized volatility,
That's a compressed spring. The backtest says it tends to expand from here. Let's add the RV percentile filter here too. Click Add Filters and search for it. Set RV percentile below 30 as well. When both IV and RV are low, the evidence from the backtest points in the same direction. Both tend to rise. You're not guessing, you're reading the data. Run the scan again. You will have tighter results, but every trade on this list has low implied volatility and low realized volatility. That's your setup. Name the scan something like long call low IV and save it. So that's it. We took you from explaining the theory to showing you our math and building a scan to put this into practice in minutes. The data is there. The filters are there. Now you know what to look for.
If you want to read the full research behind everything we showed today, scan the QR code or click the link in the description to see the blog articles. Remember, volatility isn't random at the extremes. The data is consistent across years of study, dozens of assets, and multiple market conditions. Extremes revert, but the timing matters, and the structure of your trade matters. IV rank and RV rank aren't just indicators, they're back-tested tools built to give you an edge when conditions are right. Not a shortcut, not a guarantee. A consistent statistical tendency you can align your trades with. There's a lot more to explore here. IV and earnings, IV and sector rotations, IV after major macro events. Drop your questions in the comments and we'll run the numbers.
Option Samurai has IV rank, RV rank, and IV minus RV spread built directly into the scanner. These are the same filters we used in this video. Start your 14-day free trial, run these scans yourself, and see what the market is showing right now. Link in the description. And if you want to keep learning, click here for the next video.